All right, there's our closing bell, Stu. It's 4 p.m. Thursday, and that means time for another Coach's Corner.
Yes,
so I want to welcome everybody here. Kind of a surprising week, or a couple of weeks. We had the NVIDIA earnings. Market sold off, which was kind of a surprise, and we kind of rebounded. I didn't see the close today, but I think we were down about, what, 0.5% or so in the SPY?
Yeah, a little bit more than 0.5% on the SPY, and Q's a little more, about 1%.
About 1%. So the thing that's interesting about this, I think it's a good segue into today's topic and presentation, that traders are very tempted to take very quick profits. And partly because of all the volatility. And one of the things we want to show you is that really the best course of action? All right, so that's kind of our little hint for today. And so for our Chalk Talk, which is our little thought-provoking question, we want all of you to think about this, and then we'll come back and revisit this question, answer it at the very end of the presentation.
So, Bill, I read somewhere that you says you can't go broke taking a profit. So, because I read it,
it's got to be true.
It has to be true. And
it was on the internet. So, I mean,
that's on the internet, and I did read it. So it absolutely
that's bonus points. You will hear this a lot in many different forms. And the thing that's so deceptive about it is it sounds good.
Sounds
great. And how can you argue with this? Profits are revenues greater than after expenses, that we've got something left in our pocket.
Let me teach you how to take profits, and you'll never go broke.
And you'll never go broke, right? So a lot of people kind of lean on that belief. And so what we want to do is ask you, to our viewers out there, do you think that's true? And if so, why? And if not, why? And so our topic today is, if you couldn't have guessed, there's our quote: can you go broke taking profits? So again,
sounds peg on its side.
I think he's broke. I think he went flat bust. It looks like a few pennies that he kind of somebody shook out of him. So I guess he's not totally broke, but certainly getting close there. Couldn't meet his margin call.
There's always one person at the table who's the clown, right?
Absolutely.
There's Uncle Bill. There you go.
So here's a quote, and I believe this is the original one. There's been a number of people. Bernard Baruch, who said, nobody ever lost money taking a profit. And he was a big American financier. You would think, I just find it surprising that somebody of his caliber would say this. So again, the implication is, hey, if you've got the money staring in the face, close it out, grab that profit, because that will never, ever harm you. You might look back and say, well, I could have had more if I'd have held on, but you know what? Don't worry about it, because nobody ever went broke taking a profit.
There you go.
And this is what everybody likes to hold on to and lean on. And for me, and I know for you too, Stu, it is probably the most dangerous of all of our stock market quotes that people like to recite. But the question is why? All right, so that's what we're going to answer. And before we get started, please remember, check us out, especially for anybody who's new, marketrebellion.com/get started. We have a ton of great videos, articles, things that will help you from stepping into traps like this and help you to get a good foundation to make better decisions. So lots of great stuff for free. So please check us out.
And that's the goal, everyone, to get you to make a better decision.
Correct. It's not about predicting the future and who knows where this.
Bill has no idea what the market's going to do tomorrow, nor do I. Right. Nope. So it's about getting the information to you to enable you to make a better risk management decision. That's it, right? The decision is ultimately yours. We try to provide a path for you to get there in a more efficient manner.
It's more about decision theory and how you should go about thinking about your decisions to buy and sell. So let's start today's presentation with a topic. A lot of people know the word odds, but very few people really understand what it means. Some people think it's just another word for probability if they say the odds are against you. But there's really a subtle distinction. I mean, that's sort of a correct interpretation, but the odds are a very special set of mathematics that help us to figure out what a bet is worth. So to make the point, we've got our little hat here, Stu, and I'm going to take 10 cards with the numbers 1 through 10 on them. I'm going to make a little game for you here. We're going to shuffle them up, dump them in the hat, and you are going to get to win whatever, let's say it's $1 for every time that you draw the numbers 1 through 4. So that's your winning it doesn't one number. You just got to reach in one. But if it's any one of those 4, you win.
Okay.
All right.
Yep.
So we're going to dump them in there, shuffle them up. And
it's like a carnival game. Here, you want to play the game?
It kind of is like that. And we're going to come out and find out what the math says about what this is worth, what you should pay, and what you should expect to receive. That's really the whole idea behind odds. So with the odds, here's the way that they work. Now, in that game, we had 4 ways to win. That was the numbers 1 through 4. And therefore, we had 6 ways to lose, right? There were 10 numbers, so 4 of them are winners, 6 of them are losers.
Yeah. And it just make sure everybody understands, it doesn't matter which ones, it's just 4 of them will win.
Correct. We got 4 winning slots and 6 losing ones. So one way we could look at this is that now, obviously, the probabilities or the odds are against you, right? You have far more ways to lose than to win. So we would say the odds are 6 to 4 against. Now, if it were the other way, where you would win 5 through 10, we would call that on. We would say it's 4 to 6 on, or 6 to 4 on. It just means they would be in your favor.
Odds on.
But when they're against, it means that the probabilities are against you. You're taking the short end of the odds there. Or I should say the long end, I guess. You're taking the lower probability. So 6 to 4 odds against, we can reduce that to 2 to 3. And so what this means, because we've brought this down, is that we're saying that for every $2 you bet, you should win 3. Or at least in some proportion. For every 4, you should win 6. That's what's showing here. It's just always in this proportion. And because of
and why should you win more? Because the odds are against.
Because the odds are against you, correct. Right. There should be a bigger
the world's
reward. Otherwise, who wants to do it?
Yeah, the world's giving you an incentive to bet a losing probability by paying you more to do it.
And because of that, we now can say it's a fairly valued bet. There's some level at which it's unfair and some level where it's fair. So here we would say we would bet 2 to win 3. So this is the reason that usually gamblers put things in terms of odds. They would say, because once we get our odds, we can see exactly what the bet is worth. I'd have to bet $2 and expect to win 3. And in the business, we would call that fair value. So in math and in finance, this whole concept of fair value just simply means what it sounds like, that the bet is fair. Even though you might be thinking, oh, I'm taking the short end of the bet here, it's okay because you're also getting a higher reward. There's a way to balance out. It's not going to favor you in the long run. It's not going to favor the person who takes the other side of the bet. It's fair. We've balanced them out according to risk and reward.
Yeah, of course, and you're using the price to do it. So, like, you could say, well, I could bet $250 to win 3. I'm still going to be on the winning side. If I win, I'll win the money, but it's not really a fair value.
Exactly right.
It's against you. You're betting too much money to win. It's the risk and the reward. That's
very good. That's kind of where we're going with this. That's exactly right. And people might look and say, "Oh, I can win more than I'm risking." That doesn't matter. If you pay even $210, it's no longer a good deal.
And it goes the other way as well, right? If you're betting 175, then it pushes it in your favor. Price equalizes the bet. Yeah.
Or we could say if you bet 2, but you could win 350. Now the reward is bigger than it should be according to the risk. Different ways of looking at it.
Yeah, on a relative probability against how many numbers there are to win.
Correct.
Yep.
Right. So let's look at it visually. Let's put our seesaw here. We use this a lot in Q&A for making kind of these analogies. But let's put $2 over on this side and 3 on this side. So let's say that these are, a brick or some kind of a block or whatever. And I've made them in proportion. So this has a certain area and this is 50% bigger. Right? 3 is 50% bigger than 2. Well, we know if we did this on a seesaw, it's not going to balance there, is it? And we have more weight on this side.
That's right. How do you fix it?
So to get it to balance, how do we do that? Price. Price is going to have to change. And what's going to happen visually here on our seesaw, where does this little triangle, what's called the fulcrum, where does that have to move? Well, it has to move to where this length of this is 3 and the length of this is 2.
Now it's fair.
Notice that they've switched sides. The 2 is over here, the 3 is over here. We can also multiply them. 2 times 3 is 6, and 3 times 2 is 6. And so now the seesaw will balance as long as we're in this 3-to-2 ratio. All right, so that's another way to kind of visualize what's happening whenever we talk about any financial asset or a gamble, anything. There is a price that makes it fair and a price that makes it unfair. So if you were to do this, if you were to take this little hat bet, let's call it, this is what would you expect to do over the long run, Stu? If we did this, let's say 1,000 times or 10,000 times.
I'd have fun doing it, but I wouldn't win or lose any money.
In the long run. Yep. Correct. That's, again, another way to understand fair value.
I could say the expected value of this bet is actually 0. Right?
Exactly. That's another way to look at it. Yeah. So I did exactly that in Excel. We did 1,000 tries. So I just shuffled up 10 numbers and I said, if it's 1 through 4, you're going to win 3. Otherwise, you're going to lose 2. And we just recorded the net gains or losses. So notice over here, obviously you start with no money. But look at this, at early stages, you went down. Went into the hole about $15. And then you came up, went up about $35 at one time. Look at this. We're down almost $40, back up to about 30. Lots of zigs and zags, just like a stock. But at the very far right, you came right back to 0. Now, in the real world, that doesn't mean that's going to happen at exactly 1,000. It might stay well above it for a while. But what we do know with absolute certainty, that this blue line will eventually come back and cross 0. And interestingly, Stu, it doesn't even matter where we start the bet, or I could have started you with $100 in your pocket. So we're even off the chart up here at plus 100. You would eventually come back down here. All right. So, now these red and green lines are 1 standard deviation. So we know that 68% of the time you should be in there. It looks to be about right. But if we were to do this lots of times, we would get different pictures. This is just one of them. But the idea is that over time, it just goes sideways. So the first thing to take from this is that if you're playing a fairly valued game, it doesn't mean that you can't lose. Just because you lost doesn't mean it was an unfair game. Probably more important, just because you might be racking up big profits does not necessarily mean you're a financial genius and that you have discovered the silver bullet here for the stock market.
Right.
And so that's when people start betting more and more.
I won, I'm winning, I'm pushing it, I'm
bet more and more.
And all of a sudden, boom, it's like, oh, what happened here? Well, what happened was you were getting lucky and you thought you were a genius and your ego got the best of you. And now you just kind of gave it all back. And it doesn't mean necessarily you have to give it all back in like one shot. Maybe you go into a slump and then all of a sudden it goes back and it goes back down. And then it kind of goes the other way. You give back all the money that you made and now you're actually down, right? So all kinds of these crazy things can happen in the short term, in the interim. But at the end of the day, it's the dollars that even out the
That's right. Bet. Yeah. Well, another thing that I like to look at this is that look at some of these. What might look like, if this were a stock chart, would look like a rapid sell-off. And it would be very easy to say, oh, well, the reason for that, this is when NVIDIA released earnings and the market started getting spooked, and so it sold off. Well, that's backing into it. Sure, you can always make a story that fits the picture. But a lot of the times, we just have no idea. It's just the nature of lots of people pushing and pulling, buying and selling, and you can get long streaks like this. All right, you can get all the Fibonacci retracements and all the other Bollinger Bands and everything else just from pure luck.
So how about this? So so maybe this is a stock chart, like Bill's saying, and obviously the options pricing is going to kind of go along with the stock chart in some fashion because it's a derivative and they're directly correlated. And suppose that you have some position on and the stock is going against you, whichever way it is. If you're long and it's going down, or if you're short delta, the stock's going up, whichever it is, doesn't really matter. And then you get beyond maybe you kind of counted on a 1 standard deviation for your risk management purposes, but it actually goes to a 1.5 or 2 standard deviation. You get washed out. You're done.
You're done.
Hey, but I'm using a stop loss. Well, very good. Congratulations. Yeah, now you're stopped out. Now what happens going the other way? Look, you're out. You're on the sidelines. Are you going to make the assumption that you're going to get back in at the very tip of the bottom there at that V? Yeah, that's a ridiculous assumption. You're not going to do that.
Right. So, yeah, that's another thing. People say, well, get out or take the profit and we'll just get back in. That's wishful thinking. It does not work that way. So this is the first thing to understand. Again, just as a recap, when we talk about odds, we figured out it was 4 to 6, which we could reduce to 2 to 3.
Right.
And that means you should be able to bet in the proportions of betting 2 to win 3. We could also say bet 1 to win 1.5. As long as it's in those proportions, it's a fairly valued bet. So that's why gamblers like to put things in terms of odds. Now, before we get to part 2 of this presentation, please remember marketrebellion.com/get started. Lots of great topics and videos on things just like this to help you get a better foundation. So the question we want to ask now, Stu, what happens if you take profits that are not proportional to the risk?
Well,
isn't that kind of reiterating or restating what we already said? If you should be getting 3, betting 2 to get 3, what if you're taking only $1?
Well,
you can't go broke. You can't go broke taking profits, right? What if you? Now I know this was an all or none, kind of a binary event, but let's say that it were some type of a game that still had these proportions, but you might be able to get out with only $1, and you're now faced with this situation. And what goes through everybody's mind? Hey, I can't go broke taking a profit. Let me grab the for sure $1. And I'll parlay that in tomorrow. I have more money to put into it. What's going to happen if we keep doing this?
You're not going to come out ahead.
Not only are you not going to come out ahead, what's going to happen?
Well, you're going to wind up on the losing side.
You will absolutely lose. End up
you're going to win. You're going to bet 10 to win. I don't know, 1. You're going to bet 8 to win 1. You're going to bet 8 to win 75 cents. You're going to bet 6 to win. I don't know, 65 cents, and, you'll add it all up and you'll come up with some dollar amount, and then bang, you'll have an 80% win rate. And then bang, the next trade, you kind of give it all back because,
I'm laughing because I actually have a slide in here. I know we don't discuss these, but I have a slide in here that is really that exact concept because we've talked about that so many times in Q&A. But here is...
So the next time somebody says, yeah, but I have a batting average that you can rely on of 87%, and that's why you should buy my product. It doesn't mean a thing. Seriously, it doesn't mean anything.
Right. So again, it sounds good on paper.
Yeah.
But now let's take a look at that bet, that same hat bet, but we're going to say that instead you're getting $1. You're betting 2, but for some reason it's a type of game where we can take the profits a little early. Well, there's what your risk graph or your P&L graph looks like now. As you said, not only are you not coming out on the winning side, you are dead. Look at this. You're like almost minus 900. And here's our plus and minus 1 standard deviation bands. You are literally off the charts, but to the wrong side. Now, what's going on here? How is it that we can bet 2 and take $1, but not be winning? Because again, I'm just saying hypothetically that this game allows you maybe a way to get $1 early, and you go, okay, let me take that because I can't go broke taking profits. The point is that the game didn't change. It's still 4 numbers out of 10 where you win. But if you're not allowing the profits to balance out that risk, this is going to be the result.
Bill, what's the name of that? I can't remember. What's the name of that study or something about risk? You gotta have the appropriate amount of reward for the amount of ratio, Schaefer or something.
Oh, you're talking about like the like trainer ratio and all the different ratio
like
and right.
You could walk and say, yeah, but I made more money in Apple than I ever dreamed of.
Yeah.
But what you're not saying and what you're not thinking
relative to exactly, that's a very good example. Relative to the risk you're taking, you might look and say the returns on Apple are significantly above the S&P 500. But if you look at the standard deviations or the betas, and that's where a lot of those ratios come in, you're saying you are taking too little reward relative to the risk. And in the long run, that's going to come back to haunt you.
Even though you may have won more money, and even though you may have won more money relative to a 10% average return in the market, you didn't get enough for the risk that you took, into the bet. And that's the part that people just...
That is exactly the key. So again, remember that the risk in the market is the risk of the market. It's an inherent risk. Now, granted, it changes. It's not a fixed risk like this or a roulette wheel, but whatever that risk is at any short interval of time, that's what it is. And if you're taking these very short profits, very quick profits relative to that risk, you are absolutely fooling yourself if you think that you won't go broke. So let's see how this applies to our options traders. All right, so here's where people get into trouble. Let's say a $100 call is trading for 10. We'll make it an at the money. The stock is at 100 as well. And they go, oh, I'm going to close it for 11. Now, why did we close it for 11, Stu?
Because I want to take the money.
I want to get the money. You can't go broke taking a profit.
Show me the money. Tom Cruise, right?
So now it's up a little bit and they say, oh, I've got this guaranteed gain. Well, yeah, that's true on that trade. But unless you're planning to walk away from the stock market forever, you're probably going to go back into it. And just like we saw even in a fairly valued bet, you can end up on the losing side. If you do this and take these very small profits, it is not going to turn out well. But the reason that people do this is they'll say, well, hey, that's $1 on a $10 investment. That's a 10% return in a week. Or to make themselves feel even better, we'll annualize that out and we'll say it's about a 14,000% return in a year. I'm going to be wealthy beyond my wildest dreams. That's why I need to take this dollar profit. It is gold.
That number is kind of compounded out over a period of the
10% a week. Yeah, if you compound that out every single week. But my point is that's what they're thinking. And that's giving them the fuel to say it makes so much sense to grab this dollar profit. But now let's go back into the odds. Let's go back into the math. We can work it backwards and say, what's the implied probability? So if you remember in the hat bet, we had 4 ways to win and 6 to lose. I could take the ways to win, which is 4, and divide it by the sum of the two, 4 plus 6. So 4 over 10 is 40%. I would say, well, in order for that to be a fairly valued bet, I'd have to have a 40% chance to win. So we can work the math backwards, and somebody presents this opportunity to bet 2 to make 3. Is that good? Well, I don't know. I need to know what the game is. And so I could back into it and say, does it sound like I have a 40% chance to win that? So if we do this, the implied probability to win would be 10 out of 11. Right? Or if we say the $1 win, if we put it in terms of odds, it would be pay 10 to make 1, or 10 over 10 plus 1, which is 10 over 11, or 91%.
Because look, you can kind of push it out a little bit and get a little more grasp on the big picture, on the perspective here, right? For you to make $1, it has to move $1, right? But for you to make 5, it has to move 5. Well, what's going to be easier to make, right? I mean, it's going to be easier to make the $1 than it is to the 5. You're going to have to hang out for $5 versus $1.
Correct.
So you got a lot better chance to win than $1, which is why it's so high at 91%.
Right. So what they're saying, people go, it sounds good to take the guaranteed profit, but what it's implying, if you did this over and over, it's implying that you've got a 91% chance to win. And if you think about options, just pricing, here's our bell curve. We know that the current stock price, not the stock price when you bought it, but the current stock price is the center of the curve. So let's say that this is our $100 call. Stock price is right now at 100. What's your probability of winning right there?
It kind of looks like not 91%.
It's right? certainly not 91%, right?
Right. So, is anybody in here think there's actually a 91% chance to win? I mean, come on.
That's you're talking about 50-50.
That's what it would have to be to justify the dollar.
To justify that dollar, you'd have to be playing a game where you win 91% of the time. Now, another place where traders get confused, what if the stock was way out here, let's say at 120, and you've still got the 100 call? They'll say, oh, now the probability is much greater for me to have intrinsic value. True, but intrinsic value does not mean it's a winner, right? You could have paid, let's say it's got $20 of intrinsic value when you bought it, and you paid $21 for it.
Yeah, we actually did a coach's corner on that, I think, right?
Yeah.
It's not, profit and value, profit is just
two different things, right?
Where you bought it and where it is. That's it.
So if you look at where the current stock is, yeah, the chances of this option going completely bust is low. But if you just paid $20 for it, the probability for a profit, again, you're talking roughly about a 50-50 shot, not 91%. See, that's the problem, is that when you start taking these very small profits, it sounds good until you realize that you're implying mathematically that you have a much higher percent chance to win than you do. And that's why the long-term prospects are never going to be good.
I remember what Bill said. The center of the curve is always where the stock is at that time.
Current stock.
Not when you did the trade. That's behind.
Correct.
Right? It's where it is right now. So that's how, and that's a trap too, right? That's a trap where people.
Oh yeah, bought it way back here. Yeah. So what?
My cost basis is, really? So your cost basis in Apple is $42, and now it's trading. Where's it trading? It's trading $100 and something, $92. Apple. Can't find it right now. So $190, say. So if it's trading $190 and your cost basis is $40, is that okay if you lose $150?
Right.
No,
it's still a loss. Because you could have sold it and captured that. It's still your money.
All you got to do is hit the button.
Right. So the thing to see is that no matter where the stock is, no matter how much intrinsic value you have, the moment you place that trade, that you can't say that you've got a 91% chance to win. It's just not going to happen. Now, to be clear, is it possible you bought it with the stock way down here? It's moved up and you're saying, even if it moves down here, I'm going to have a very big profit? Of course, but you took risk in the interim in order for that to happen. So you weren't out of the weeds free and clear. Yeah. You took risk and it went in your favor. But if you get onto one of these campaigns where you're going to always take profits or clip them at the first sign of profits, it will come back to haunt you. So here's another thing that traders like to do, and I know we've heard this many times, where they'll say, my whole goal is to have a high proportion of winners. But here's the problem with it. So let's say you pay $5 for the option, you sell it for $5.30, and you've got a 30-cent win or 30-cent gain. You go, hey, but I've got my first W. I'm trying to get a high because you can't go broke taking a profit.
No.
I buy a second one for $4. I sell it for $4.40. I'm 2-0 now, Stu.
Excellent.
And I do all of this, and then suddenly I'm 7-0. But what people don't realize is that the implied probabilities are so far against you. So if we add these up, comes up to be right here, this column is $3.40. Okay, great. You've banked $3.40. But take a look, if you continue on this path, any one of these going bust is going to completely wipe that out.
Any one of them.
Just one of them. Right.
That's just one of those. If you look away and a stock
takes one day for that stock to gap down, it's gone.
It's gone. Right. So how did you do? You won.
Yeah, you could still say you're 10-1 or 19-1. It sounds great on paper.
7-0. Oh, it's okay. I lost one. So what? So what means you're now minus.
You're minus. And that's why a lot of traders will tell you about what percent wins or their percentage record. I'm 19-0 because it sounds like they must be up, and they're not. They are two different concepts. And then another problem, talk about a death spiral. If this happens, let's say two of these go bust, and you're going, well, how long is it going to take me to dig out of, let's say, a $12 loss at 30 and 40 cents a shot? Now you've got, and that's assuming you have no more losses. So what happens that people say, well, now I need to buy 2 contracts or 3 or 5.
Double up on your risk.
And now it's now even more a matter of time before things go from bad to worse. Right. So the question now is, hopefully we've convinced you that you absolutely can go broke taking a profit. Well, the question is, how can you protect profits but stay in the position? See, that's the big thing that they're kind of the everyday traders out there don't understand. They say, look, I just put $10 into this option and it's worth 12 or 13. I don't want to see it all evaporate. Let me close it.
Right? Which is all or none. I mean, they're all in or I'm all out.
You're either all in or all none. But the professional trader says, look, okay, it's moving in our favor. Maybe we need to squeeze this more to make up for the times that we don't have any winners. But how do we do that? How do we kind of play this middle ground and stay in the position, but still capture more profits? And that is where hedging, rolling, and morphing come in.
Bingo.
Right? We've talked about these before in Coach's Corner. We talk about it all the time in Q&A. But for those of you out there who might not be familiar with it, let me show you what it means. Again, this isn't to give you the details as much as the concepts. You start off with a $90 call, and maybe you paid, these are like 6, I think I did 6 contracts at $6 a piece. So it's $36 total. That's where we're lining up down here. That's your maximum loss.
Okay.
And then later, we're able to roll it. So the stock has moved in our favor. I can sell the 90s and buy the 95s.
Now, Bill, you're not rolling out. You're rolling.
We're just rolling up. Correct. We're staying within the same expiration, although that is another type of roll.
Yeah.
But generally, for longer term trades, things like stock replacement, we will look for an 80% of the difference in strike. So if I roll to the 95 strike, I'd like to get a $4 credit.
And what I'm going deltas, don't even think about that 80%. It doesn't matter, right? Just
where delta is going to stay about the same. Our goal is to get this risk graph to sit up off the bottom.
Yeah.
Now you can see we do have to give up a little bit of profits for any given stock price out here. The black line sits above the blue, but that's the exact definition of a hedge.
So Bill, if I have $100 strike and the stock moves in my favor, should I roll it to the 101 strike? It's a roll.
Probably not. That's another common problem where people want to just take. It's very similar to this problem where they're just picking up nickels in front of bulldozers.
But I rolled it and I got paid 50 cents. Yeah, but you just paid. Not
to mention the commissions, right? Exactly. That's why I said this isn't meant to be a training class as much as it is just the concepts. But the key is that we've raised this up off the bottom, and in doing so, I take $4 times 6 or $2,400 off the table. Now we get another situation. The stock continues to run. I roll from the 95 to the 100. Now look what happens. The green line sits completely above zero. So I've gotten my initial $3,600 back plus a guaranteed profit, but I still have unlimited upside, albeit not as profitable as if I didn't roll at all.
And you can work those numbers kind of up front on the first one by trimming, adding a trim. That's just money coming out.
Hold that. You're always one step ahead of me. That's exactly right. Because what could we do if I really want to get some money off the table? Instead of the green line, I could maybe sell half. Okay, so now I'm going to get a bigger credit, but I only have 300 deltas out here instead of 600. So that's why the red line isn't as steep, but I still have unlimited gains. What else could I do? Well, maybe I say I'm more interested in the profits. Maybe for other reasons, I think the stock might be starting to stall, hitting some resistance, but I leg off into a vertical spread. Now I might be able to do this. I've got a bigger credit. The gray line sits higher than any of them. I still have some deltas in the middle where I can still make some more money, but I do have this area capped off.
So can I sell off half of them, 3, and can I sell 2 on the vertical spread and leave 1 open?
Exactly. Who says that you right? What if we wanted to come in between the red and the gray line in here? Sure, of course that's possible.
Is there a rule book that says I can't do that?
Not at all.
No, right?
Just limited to your imagination with this game.
And then even on the red line, right? So these are expiration curves. On the red line, what's going to happen in the interim if the stock continues to go up, right? That delta is going to pick up from the gamma.
Oh, yeah.
Right. And that delta and that gamma is replacing the delta, not all of it because you sold some off, but
correct.
Or whatever 3 of the contracts were. But you're going to be picking up delta on the remaining 3. It's going to be replaced. So it's actually an incremental decrease. It's actually an incremental decrease of the difference that you lost on the way up.
Absolutely.
Yeah.
Yep. So the thing is, there are all kinds of things we could do here. We could go into back spreads. We could go into ratios. There's all kinds of things we can do depending on our goals, mostly risk tolerances, everything else. But the main point I want you to understand is that there are ways to stay in the trade, but also manage the risk. See, that's the missing link for most people. And that's why they are so tempted to pay $5 and then sell it for $5.50 and then talk about what a great percentage return it is. That's called a matter of time before that comes back to haunt you. So, Stu, what did we learn from all this? True or false, everyone? Next time you hear that, what's the answer?
Let's see. How do you do it? No. False. How's that? There you go.
Absolutely false. That's why it is one of the most dangerous expressions on Wall Street. And this is why. The math just does not support it. If you are not taking rewards that are proportional or commensurate with the risk you're taking, I call that strategy a matter of time. You might be winning now. You might be 19-1, but keep doing it.
Yeah, it's like, you go to the casino and you play roulette, right? So
lots of people win in the short run.
The odds are against you. They're 5.25% against you, but you could sit down and, you might win a couple $100.
Sure.
You get leave and you won, right? You had a good time. But if you sit there and play
for weeks and weeks and months, right?
You're
very good chance the longer you sit there, the more guaranteed it is that you will end up on the losing side. Yep. So we hope that gives you some great things to think about. Remember, that's kind of our whole idea here on Coach's Corner, give you better ways to make decisions. And so if you get nothing else from this, remember, if you're one of these people who likes to pick up nickels in front of bulldozers, that's a former floor trading expression from you guys, right? I understand that's kind of the same thing where people would want to just scrape up these little pennies, and we know where it leads.
Let them breathe, baby. Let them breathe.
Yep. So if you're not getting the results that you think you should be getting from options or just investing in general, this is a very good reason what's happening. And what will change that is if you learn how to hedge, roll, and morph. So I hope that at least gives you some good things to think about. I'm sure we'll get some good questions next week in Q&A, Stu. But for everybody else, we hope that at least gives you another building block to help you make better decisions. And thanks for being here again, Stu. I think we got to get Scotty on next week if we can.
Okay.
And we'll see all of you next Thursday on Coach's Corner, 4 p.m. We'll see you then.
Yeah. See ya.